Hey there, and welcome back to the Fuse Show. I'm your host, David Tran. I'm also a co-founder of Xfusion.io. Today, I'm here joined by Peter Bakker. He's a co-founder and CEO of Unhedged, a platform that uses AI to deliver hedge fund tools to the everyday investor. Thanks for joining us on the show, Peter.
Yeah, great to be here.
So you've had quite the background on your LinkedIn profile. I've seen you've worked in importing, business development, finances, marketing, and operations. How did all of that lead you to be where you are today, and what made you want to start Unhedged?
Yeah, that's a good question. I mean, all these experiences reveal my age a bit, but yeah. So as a let's say a older entrepreneur, I was lucky enough when I was young to start a business in '96, and timing was with me, right? So internet started. I was quite enamored by the concept, but I started my business initially to fix something that doesn't exist anymore. It's the Y2K problem. And actually, in hindsight, there's always a discussion whether it ever existed or not. But the bottom line was that because I used to be an army man before university, and I was cleared to do things for the army. And the army had a lot of software that was very old. And so in the end, we had almost 200 people working for us in the army and government to scan and fix software. And that became such a relatively big business. I was 25, 26, and I thought, whoa, need to manage this better. And so I started to build software to manage my team. And then that software, at one point, somebody saw it and said, can you use it? So yeah, sure. And that became a project management suite that was connected to SAP and to some other things. And so, yeah, that we sold in the end. But the thing that really was, for me, the thing that made me think, okay, this internet thing is never going away again, is that we built a software for a internet front end for SAP. SAP at that point was like green screens, right? Beautiful. Two colors, green and black. And and a lot of people, they were starting to use the net, and they said, why can't we have like an internet interface to put all our hours in? So I said, yeah, we'll build one. So we basically, that was our first foray into SaaS, what they call now SaaS. It was because we sold that software everywhere. And then, so we sold that business, and then I gained some wealth, and I thought, okay, I don't know anything about wealth management, so I'll give my money to financial advisors and asset managers. Very good. And you know what I do? I take some money and I travel around the world. So I traveled for 2 years around the world.
Nice.
I followed the route of Marco Polo from Alexandria to Beijing overland. Traveled in all the countries that are designated dangerous now. But yeah, it was a fantastic experience. But when I came back, I was, okay, what business am I going to start now? And then I discovered that those dear people of the investment bank had half my money very professionally. And I said, yeah, but I paid you quite a bit of fees, so how are you going to explain that? He said, no, the losses are yours, the profits are yours. We just do a job. So, well, you did a very bad job. And so that's how I started to do my own asset management. First, very simple, and then more advanced. In the meantime, I started another business. Then I went to INSEAD to do an MBA, and I worked for Google. At Google, I ran a part of the AdWords sales organization in Northern Europe. And after that, I didn't sorry for all the zooglers there, but I didn't really enjoy Google, because Google was at that point very fast growing, and basically the only thing you could do is hire more people. And there was not much, especially in my area, there was not much innovation, much to do. So I left to become in the end CEO of a business called Bakker, which later got rechristened to Made.com, M-A-D, which IPO'd this year. And so when I left there, went to Australia, and I thought, okay, now I'm taking all the things in my own hands, because now I have all these assets all over the world, and I need to manage it. And that's where I felt that the nascent industry of AI and machine learning was really something to look at. So, and I went in this rabbit hole, and I never came out. Went in deeper and deeper. And so in the beginning it was very simple, rule-based stuff, but later I worked with Quantopian, which was a Boston-based firm that wanted to democratize algo trading. In the end, they failed. They got bought by Robinhood, so maybe they didn't fail internally. But the platform, they built this big Python open source package called Zipline. And I became basically a contributor to Zipline, and later on we took the Zipline package, forked it to a live trading version. And then I spent so much time, and I thought, there's a business here. So I started the first business with a VP from Amazon on the side, like a side hustle, like let's make a marketplace between algo traders and investors. That doesn't really work because algo traders, they don't give their code, so you can't really look at the code. Secondly, we looked at the trust factor in investors. If you can't see the code, if you can't judge the code, how can they, right? So that was a really hard problem. And so we tried there to do a lot with crypto as well. So how do we maybe make these files encrypted on the blockchain and then only unpacked through a smart contract? So we went all the wrong way. Then we decided to make an application. You see them more often in the US and also in Australia, is that you basically give signals to people who trade that on their own trading account. But the problem is, then you can't use the free brokers in general at that time. I mean, later Alpaca came and Robinhood, etc., etc. But most people, they have to trade in an account where they have to pay costs. And so you don't have a prime brokerage deal, you don't have the speed of your own computer or your own server. So that really didn't work either. So then we decided to fully pivot to a model which is that we have an app and we have a fund. And the fund has three algorithms that run live money. And you, with the app, can put in money in the fund, and you can decide which algorithm you want most. So you can make any ratio you want yourself. So which is a completely different concept. So we basically use the modern portfolio theory not to rebalance assets, but to rebalance return streams. And that's basically the same method that is used by Bridgewater and Double Line Capital, and although they have 1,000 PhDs and we have only a few. But it's the same concept. And I really looked at the hedge fund world, like what can be different. And there's, I don't know if you heard about the blue ocean strategy. It's
I'm familiar with it, yeah.
So it's basically a way to look at where do people fight in the market, the red ocean, and where is there blank space. And so we believe that the blank space is in a platform that allows you to invest very simple, have a lot of control and transparency, but with the tools to make it incredibly simple. So if people don't want to read further into it, they just can say equal weight, and then it just goes, right? In 4 clicks, you are invested. But if you really want to look deeper into it, you can read about the algorithms, you can see their patterns, you can change the ratio between them, you can rebalance or not, etc., etc. So you have, because we believe that if you look at the newer generation, the Gen Ys and the millennials, they are a little bit despondent by all the boomer and Gen X way of doing business. One of the things that we really hate is charging fees for nothing. Right? So if I deploy my money, and as I told several times, I go to a financial advisor, he writes a report, 80 pages, only the last page is useful. The first 97 I took over his ass, not my ass. Then he says, okay, go to this asset manager and he will deploy your money. So now I paid for this report. Sometimes I have to pay 0.5% of my money. Then I give my money to an asset manager. He also charges me 0.5%, 1%. And then he buys ETFs, which I could have bought myself. And the broker charges me, well, I could have used a free broker, but they don't have a deal with a free broker, et cetera, et cetera. So the majority of people who are using the old-fashioned structure, they are 2-3% every year in the hole. And there is no way they get charged on a performance basis. So that's what we decided. We said, okay, we have now a very low management fee, and we have a performance fee or a success fee. So if we overperform the benchmark and we hit a high watermark, so we make you more money, then we get paid. And in the end, it will come down to, in a good year, let's say 1.6%, but who cares? You have made so much money. We get a little bit of a performance fee. And so that's really where we believe we should go, right? And my ambition in the end is to make this AUM fee or management fee 0. And if we manage to do that, and we have to grow a little bit bigger for that, then we have a fantastic business where people can park money without any cost. They only pay when we do better for them. We are incentivized to create new algorithms. We maintain the running algorithms, and yeah. So we start now in Australia, but we are very ambitious. We want to go very quickly across the pond. We found that Singapore is a good place to be. UK is a good place to be. Some US states.
How do you decide?
Well, we have found that the major hurdle for this industry, and hurdle is good, right? Because I don't mind hurdles. Hurdles are moats when you have passed them.
They are moats. That's the way I see it too.
Yeah.
The harder it is, it means the harder it is for the next person to come in to disrupt.
Yeah, and that's what my team says sometimes. Like, this is so hard. Can we do this different? So yeah, we might, but probably not. But don't worry, the harder the better, because the next guy can't cross that easily. Anyway, so we found that the regulatory environment and the attitude of regulatory regimes is the determining factor for us. So that's why the US is an extremely hard environment to be in. First, there's a lot of competitions in robo. Yeah, so you have, I don't know how many robos, but I think 40, 50 good robos, right? And all the wealth managers like JP Morgan, all the big ones are all in the game, and they call themselves robos. I would not say that's any form of advanced robo, but let's see the good ones like Alvest, who targets women only, M1, so many sig figures so far, etc. And they struggle. If you see how much profit they can generate for their users, and you look at the internals, then you see they spend a lot of money on regulation, a lot of money on trying to be compliant. And that, I don't think that's a burden I would like to go into immediately. So yeah, we look at regulatory environment. And Singapore is very friendly, and also because we believe that we are starting here in Australia one asset class in stocks, right? But the basically two ways, or multiple ways, but there's two main ways to grow this business. Is one, to go to another asset class like crypto, and we know all our algorithms work very well like crypto. But then we have to go to a regulatory regime that actually accepts that, right? Accepts that crypto is here to stay. And Australia, they still have the finger like, oh, you will lose all your money.
It's not untrue for some of the meme coins.
It's not untrue. It's not untrue. But I think we have to separate the all the dog breed coins and things that are created with a wild plan, especially in 2017, with the coins that are creating now a secondary highway to the traditional finance structure. That I think for a long time I was afraid that regulatory forces would step in and just annihilate it, like they tried in China a few times, and it could have been done. I think in 2018, if there was a coordinated effort over the world to kill this, it would have been close to be killed. It would have gone on underground. But now the genie is out of the bottle. It's just too big, and I love it.
Me too.
No, and I love the fact that all the values, or most of the values of these projects, they are not about becoming rich. Right. There's a lot of groupies around it that scream to the moon and this and that. But it is about democratizing finance in the end. It is about creating. I sometimes say to people here in Australia when I do something in town, I say, look around, look at these buildings. All these buildings, they're high rises, and they have names of banks on them. Who do you think paid that? You paid that. You pay that with your savings. You pay that with your investments being overcharged.
Every time I drive by a fancy fancy bank, I ask myself that question. It's like, how do they pay for this unless they have tons of profits? And if they have tons of profits, why not do something else with it? I don't know. I feel like there's a major lack of innovation.
Absolutely. Lack of innovation. But why would you innovate if money just streams in? And because I'm now a little bit longer in this industry, I'm just amazed about how backwarded things are. I mean, we had a long discussion with a few banks about hedging our currency exposures. And if you just ask like a big bank, how do you do that now, right? So when I go to you, how do you do that? Oh, well, then we see you send us a message. So do you have an API? Yeah, we do have an API, but then it becomes an email to my desk, and then it was okay. And then I type the number in a spreadsheet, and I go to the market. So what does that mean? Go to the market. Oh, I'll make a few calls. I thought, okay, that's insane. That's insane. And the same experience I had with an old type payment provider who said, okay, I need to have direct debits of $50,000. How do I get that? Oh yeah, you can do that. You send it with the API, and then it gets 50,000 takes a bit longer. So why does it take a little bit longer? Oh, well, yeah, because when we see it, we get a message on our terminal, and then we turn around to another terminal and we type it into the bank. So well, I can go into the bank. I mean, I don't need you for that. And there's so many things, but the money keeps on going, easy. And there's the guy's job is to turn around on a chair. You can have a smart contract doing that, right?
Right.
You can have, I mean, there's so many things. And these processes are so archaic, and they don't want, I don't think most banks are internally incentivized to destroy them, because it makes a profit. And so, yeah, in crypto, I'm looking forward to all the building blocks that the teams are building to disrupt this in a very thorough manner. So only the question society has to choose what to do with all these big buildings. Convert them to apartments? I don't need them anymore.
When you were first thinking about using crypto as a solution to, I don't know, encrypt algorithms or encrypt results of algorithms on the blockchain and have only one party see the result of that for execution or for storage, how long did it take you to build that? And what made you want to go the crypto route versus a more like, I don't know, other form of like sending messages in a semi-private way?
Yeah. Well, I think the whole finance industry lacks one thing, like the traditional finance, this transparency. So for me, it was more important that. So, for example, if I'm investing in a hedge fund and they do algo trading, I never know how advanced those algorithms really are. I don't know.
That's true.
I don't know how.
Could still be a human.
Yeah, it could still be a human. But also don't know when they change anything. So, if I know now, I'm in the industry, and if you change an algorithm or not, they don't work. Basically, you're just playing around with rules. People are jockeying a backtest and then find a better parameter, right? So it's not real professional behavior, and you see a lot of people doing it. So one of the things that I wanted to show by having these encrypted algorithm files that basically are the Python code, that the moment you change something, the signature will change. So then the developer needs to explain, what did you do?
So how would you like to approach it at your company if you were free fully from all of, I don't know, let's say there is zero regulation, how would you like to communicate?
Oh, I would really so first I would save a lot of money because I spend too much money on lawyers, right? So I spend so many, and I often ask them, and I get a smile back. So how much value are we adding for our users here? And usually they say, we're just protecting you. We're protecting your company. And then I always ask, but from what? And they say, from people suing you. Okay. Yes, that might be true. So without regulation, because I think regulation in general is good, right? So
right.
So regulation to stamp out fraud is good. Regulation to have a certain level of education in the industry is good. Regulation on which tense I use in my sentence is not so good, right? So it would save a lot of money in lawyers, that's one. I think what it also would do is we would be more freely to talk about what we're doing. Because at the moment, there's only a certain amount of detail I'm allowed to give.
Right.
And I would like to give more detail. And because this is, how I see this is a little bit as such. Like, what we are doing is not high-frequency trading. So what we're doing is not isolating alpha and then pumping billions of dollars through it, like a lot of high-frequency shops do. They basically do arbitrage, find pricing mismatch, etc. That's not what we're doing. We are doing automated investing. We use a lot of techniques that they are using. But the techniques they are using are often applicable to smaller time frames, or to bigger time frames. So they use a nanosecond or microsecond or second level. We trade we monitor the market on tick level, but we decide daily what position we take, and then we slowly move into position. And then our average holding time is 18 days. But yeah, and then based on the market's behavior, we scale in and scale out. But in the end, it's investing. It's not trading. Mm-hmm. That's a very important thing. So without regulation, we could actually tell more what we're doing, because I don't think we should. I don't think we should have that many secrets as an industry. Because if you buy a car, you get this beautiful book, and if you're very interested, you can buy a bigger, beautiful book, and you could maintain your own car. And some people are very active, and they read that book. And after they read it, they bring it to a dealer to get maintained. So the fact that you know how it works doesn't mean that you want to do it.
Right.
Yeah? And so that's how I see this industry as well. When it comes to investing, people are very cagey about how they create these portfolio. It's all academic research. You can do it yourself. You could, if you spend a few years of studying, you could develop these systems yourself. But most people want to sit on the beach, play with the kids, drive the car, do some fun stuff, right? The fact that I and my team think this is fun is more a brain deviation.
I've got that same brain deviation.
But it's more the, it's the same as a lot of SaaS companies will do certain things to it. It's not that you cannot do it yourself, but it's more effective if you let somebody else do it. And we can make good deals with prime dealers. So we only pay a few bips a few basis points per transaction, while if people go to most brokerage platforms, they pay dollars. And even now in crypto, right? In crypto, there's also this enormous bifurcation in some chains having extremely high gas fees, while other chains which have the same, not the same size, but the same applicability, they're very low gas prices. Well, at one time, if Ethereum and the others are not going to play ball, somebody will eat their lunch, because there's no reason to pay more to miners that don't add a lot of value. A bit.
Earlier, you were mentioning trying to get your fees down to zero.
Yes.
What is the business, profitability case if the fee is zero? Would you start diving into like other services? Would you dive into like some form of way of making money and just use this as primarily for like lead gen? Like what is the play to sustain and build your team over the long term if you were able to get your fees down to zero?
Yeah. So if we can get our fees down to zero, we did. I'm a big fan of because we do so many data analytics games. We do a lot of Monte Carlo analysis. So we basically looked at, okay, if you try this 10,000 times, when do you go bankrupt? Mm-hmm. And we never go bankrupt, because as long as you have enough capital to survive a dry spell, it's fine. And the longest dry spell we can find is about a year. So when you have a big bear market, right? But our algorithms are very good in general at detecting stress in the market and then jump out. So what we say is we're not trying to insulate alpha. Yes, there are some alpha we try to insulate, but what we primarily are is beta switchers. So You know when to get out and wait. And if you consistently, or 80% of times that there's a big dump, you're out, you win more by losing less. So if we make our fees zero, the longest period we can be without income is like a year, we expect. But in general, we get paid about 45% of the months. So 45% of the month we hit a high watermark and do better than the benchmark. And the other months we're either trailing it or we're in cash, right? So sometimes we're in cash, the market goes up or down, I don't care. But at one point when I go in again, I have to still overcome that same benchmark, right? And so, yeah, if we go to zero, that will cause a few things. A lot of capital inflow. Because a lot of people think, okay, so I can get this fund manager that has this track record, and I don't have to pay any cost unless he makes me more money. Yeah, give me more, right? So that's one thing that's going to happen. So while our team doesn't have to grow to the same rate, so our team can stay relatively stable, or we have to of course expand the CX and the customer service and etc. But relatively stable, and then with more inflows we get more money in, and dry spell can still be a year. But when there's no dry spell, we make plenty of money to create the income we need.
Or to elaborate, if you made the fees zero, what are the means through which you would make
still the
money?
Still the success fees, right? So
success. Okay, I see.
Yeah.
So based on success, I see what you're saying.
Yeah.
Okay.
So I don't want to make all fees zero, because then indeed you need another business model to make it work.
Okay, gotcha. I understand now.
But it's the fees for doing nothing.
Right.
So a fund in theory, can start a fund, do nothing, and just cash fees, right?
Right.
Or they can lose your money and cash fees, right? So that part I think is unfair, and that part we should get rid of. And so there's and especially if you look at, you still need to do something in terms of fees, of course, but you could go to a per click model or per month model or whatever. But I think it's all too hard, because if you work in a fund structure, you charge the fund, and so you can't allocate. I can't say this is David's money exactly, and then deduct it from David. I have to deduct it from everybody. So that's basically how these funds fees work. If you want to charge you specifically, I have to, next to the you have to invest, I have to get your credit card to charge you, which makes it basically a very difficult model. So that's, there's a lot of people who go into this is a little bit of a venture thing, David. So you could go into wealth advice, and you could go in other things, right? So like Alves does beautifully. They give career advice to women to get better paid, right? So and they help them negotiate their salaries. Awesome. So they do two things. Well, they create the gender equality, if they help to get there, and they have an additional service that people are willing to pay for. Therefore, they can charge a little bit more. But their investment model is still archaic. It's still a bunch of ETFs that gets rebalanced every quarter, and three old guys in the building, they will decide whether to take ETF E or B, right? So it's still very old-fashioned. But their business is very innovative, that they are going to a certain group. So I haven't seen in our community a need for these things. So haven't found it, but it doesn't mean that I will not find them. But what I do believe in is that algorithms and AI, ML in finance will rule the world at one point. There will still always be people involved because, it's a as long as there's sentiment in the market, there will be people influencing that sentiment. And sentiment you can read with machines, but interpreting that accurately is not that easy, right? I've seen now experiments where people take video of the CEO on CNN and then see whether he's worried or not.
That's actually pretty interesting. That's very creative.
It's very creative. But,
yeah, it's creative.
But now, what is he worried about? Whether his mother is sick, or his children don't go to school, or his business. I mean, in the end, if you could read it, fantastic. But what are you reading? Anyway, so and I love all that kind of stuff. But I believe that our business should go to lateral asset classes. So crypto is a clear challenge, and cater for different types of customers. So, for example, we have seen now in our user base that we attract younger people. So, let's say 25 to 35 people who need to invest and have all these smart financial tools like buy now, pay later, and blah, blah, blah. But in the end, they just need to invest to get along, especially if you're a gig worker. Then you have to be even more conscious about how you take some of your money and invest it, right? Because if you just live hand to mouth, you will create a problem later, and the problem will get bigger and bigger.
How'd you learn how to do the more technical sides of your business? More, I guess, in particular, the AI and the math and all the things of that nature.
Yeah. So I'm a sociologist by trade, and sociology is statistics. And so I've been doing this as long as I studied and worked. But then in my MBA, I did a lot of microfinance. So because I got really interested in this algo trading at my MBA, I was in 2006, and my prof came in, and he put up this article on the board, and it said that the yield curve was inverting. And he said, if this will happen in the next 2 weeks, and this happens, we have a recession in 18 months. And I was like, this was 2006. People were throwing money at everything. And it was going well, right? And the housing market was exploding, and it was beautiful. And 18 months later, we had a recession indeed, right? So then I got really interested in, okay, there's these macro forces and these micro forces, and in the end, if you look at machine learning and AI, it's all statistics, yeah. And
right.
So yeah, that's how I got into it. And it's a lot of experimenting, right? So AI 10 years ago, it's always the question, what is AI, right? Because intelligence...
Very blurry definition.
Very, very blurry. But I make a difference to... So for me, the difference is that ML, machine learning, and deep learning, I think they are deterministic. So if I put the same data in all the time, I get the same outcome. And I need to tune parameters, I need to tune layers, I need to tune regression, etc. But it's very prone to curve fitting. then AI for me, real AI, is that it's non-deterministic. There's a randomness in it. And it's like genetic modeling, right? So the fact that we got dinosaurs at one point and birds now and people now, that is the randomness was a selection is the tool, but randomness cannot be excluded. There's a probability that something would have happened. And there are millions of scenarios where you would have created an Earth without humans, or without animals, or without dinosaurs, right? And so when it comes to, and this makes AI, what I call real AI, hard in finance, because regulators do not want you to be indeterministic. They want you to have the same, you have to be proving that you have the same outcome every time with the same data, which is a fallacy by design, because if you know how data is created, right, if I do a backtest on data that is cleaned, that was not the data I could have received at that moment. And and how do I know that there was an internet outage in 2 seconds over 2 seconds past 6 this morning, and we had 50 misreads, and that's I cannot get those misreads back, right? And of misprints, and so it's a fallacy, but academically, the academic argument is for a regulator that they want to have predictability in the outcomes. And therefore, you have to be being able to replay your algorithm with the same data, same outcome. I don't know if that is really needed. And I think there would be more creativity if we would let that go. But it's more the moment you say...
When would a regulator come in to even ask for that test? Like, how would they even know as an outsider?
They wouldn't know, but before you get to the regulator, you have to pass so many lawyers.
I see.
And lawyers are deterministic in their outcome.
If they're doing their job right.
They're doing their job. But it's a matter of so it's if you would have so I had discussions with regulators about this, and they have that opinion that you say, well, I said, well, there's some randomness, right? So it means that you cannot control, even if you pretend you control the outcome with clean data or with the replay data as it came out, then it doesn't. If you would replay it, you don't have all the players in the market.
Right.
Yeah? And if all the players in the market exhibit some form of randomness, then the fact that that data came out of the machine, I can guarantee that that same data cannot come out of the machine a second time, because there's randomness in the system. And they say, they ignore that on purpose, because if they have to accept randomness, random outcomes, where the guardrails of an algorithm catch the randomness and then decide to go out or in or don't do anything, right? Because you have to code for it. Then they have to also accept that all the things that they believe are cause and effect are untrue. Because they have a lot of mental models on cause and effect, right? So the most simple model is we lower interest rate and the economic activity goes up. Well, yes, that's true. As long as you don't have a demand and supply crunch we have now, especially in the US, where it's not a demand problem, it's a supply problem. So whatever you do to overheat the economy, you're going to drive up the price, you're going to drive up inflation. Somehow because they don't think in supply but in demand, it's outside of their realm of possibilities that the world could be different than they think now. And yeah, this is the psychology of economic theory, and the psychology of where you basically say, okay, what do you believe? Do you believe that people are always homo economicus? Are they always chasing their own goods? Or is there altruism? Is there randomness? And I believe there's randomness. And because, I'm not always 100% with the program.
So there's a blog post I've read by this author, Naval Ravikant. Mm-hmm. He's the, I think, founder of AngelList. He talks about macro versus microeconomics, and I think it's so interesting how he's like, forget the macro stuff. Like, there's so many people at the macro level who have alternate opinions that conflict at some point. And at some level, I think it's just really hard to, even if you could model it moderately accurately, you still have to deal with the fact that, like, okay, so what? And I think it's like, oh, you're right. Even if I could model it correctly, it's actually kind of hard to do something with it. Yeah. And that's a big if.
Yeah, and there's so what often people say, and I think I don't know how it was in the US, but here in Australia in the COVID crisis, there was something really remarkable. And that is the remarkable, we had enormous lockdowns, right? So we were the longest lockdown city of 250 days, which was, of course, terrible for kids and mental health and a lot of other things. But when I started reading into it, because they always claimed, we have this model, how many deaths we will prevent. And then I looked at the model, and the model had an 80% confidence interval. I don't know any academic that could get a PhD if he presents a model with an 80% confidence interval and actually thinks he can make a decision on it. Because 80% confidence, that's basically, if you are a Bayesian statistician, 80% confidence is pretty much random.
It's a dice roll.
It's a weighted dice, but they locked up 6.5 million people in Australia based on that model, and I think here we have clearly a problem in first model usage, but also the transparency about how do we use it. And that's why I would like with my company to be far more transparent. It's like what is the chances it goes wrong? Well, it's this. But the moment I say, well, it's for example, one of the things that I follow very strict in my algorithms is the probability to make a profitable decision. And you want to be as high as possible. So we strive to get to 70%. And sometimes we go a little bit higher, sometimes we go a little bit lower. But if I would say to the regulator, my models have a 70% of making a good decision, they will say, you can't put this live because of the 30% of a losing decision. Yeah, I know. But not better than the market was a random walk. Because that's exactly 50% according to you guys.
70% actually is pretty incredible in my mind, because it's not like you need to win all the time. Even if you just won a small fraction of time over a certain amount, and it was weighted properly, then that's exactly plenty of opportunity in my mind.
It's so there's two things you have to look at when you come to trading, and especially in crypto, that's a very, very good thing to look at. It's your win rate, and the second is how much do you lose if you lose, how much do you win if you win. If you win equally, then your win rate should be higher. But if you lose less if you lose, and you win more if you win, then that win rate can be as close to 50% or even below that if you want. And that's
venture capital firms work off a success rate of like
5%,
2 to 5, single digits.
Single digits. But the win and the loss are so different. And the same for crypto, right? So for crypto, that's why I invest quite a bit in crypto, because I want to understand it, and I read the code, and I want to know what the smart contracts are doing. Although nowadays it becomes so complex, it's pretty hard to read the code. But if you put a uniform amount in all the cryptos that have a decent, I look at the team, I look at the buzz, I look at a few other parameters, and I'm using quite a bit of services that analyze teams and their experience, and et cetera, et cetera. But if you put a uniform amount, I don't know, only 10% has to go up, but they have to go up a lot. And then the rest they can go to zero. And they will go, and a lot of them will go to zero. So that's a really asymmetric bet. And in as a person, so as just a citizen who is taking care of his life and doing all the things, I believe that the best way of investing is a barbell construction, where you have basically a barbell with safe investments, and safe can be your house and services like ours. We don't make 100% profit. We try to make a few percent over the benchmark. And then you have barbells on the side where you take asymmetric bets, but you take them with a small amount of money, and you take them uniform. And if you do that, then it will pay out. And I have a few examples of that in crypto, but also in life. In life, I worked for a lot of startups, and I always try to get paid as little as possible in cash and as much in shares as possible. So I have this huge portfolio of shares or of private companies. And I think for the first 15 years of my career, I didn't make much of it. Sometimes I had a bit of luck here and there. But now I get every few months, I get a call like, we're going to IPO, there's some small holding you have here. So, okay, fine. No problem. And so I use my career also to make these small bets, which don't cost me a lot. It was just my time and my effort and my knowledge and my insights and whatever, and maybe the right time, right place, and some other serendipitous things that I didn't know. But all these things start to pay out now. And so I believe this whole way of seeing life and seeing investing is actually quite like. Just don't make stupid mistakes of marrying the wrong woman, or the wrong man, because that's very costly. But for the rest, just safe investments, barbell investments.
Are you familiar with Nassim Taleb?
Yeah. So Nassim Taleb has voiced that opinion quite well, but I think he looks at it from a very narrow point of view. I think we should look at it from your life point of view, and because there's a lot of times in your life that you have the opportunity to take a small asymmetric bet. Most people don't take it.
Yeah.
Most people go to a bar instead, a few beers, or buy a depreciating asset as a new car. I still drive a 20-year-old car, but I'm a bit older than that. But yeah, when I sometimes I think, maybe we should buy a new car. And then I think, why am I going to pay $100,000 for a new car? Well, I have a car at work. And with that $100,000, I can buy I can take 10 small stakes in angel lists in syndicates I know work very well because they already worked for me very well. You know, for me, it's more the trade-off.
For sure.
Yeah.
I really like the idea of taking asymmetrical bets where you feel like it's appropriate, where you feel like it doesn't cost a lot, either in time or risk or energy or whatever, but the potential for reward is high. And I think people are a lot more risk adverse than I think is rational.
Yeah, exactly. And that's also sometimes what I say to my team is it's very hard to. So what we give to people is all the control, you know. And what we see is people play around with it. Oh, I can determine this. I can take more risk, less risk. Great, equal weight. Because in the end, we give them a tool that they could determine, but then they also have to do the work. They also have to do the reading, what they do, and what is their belief in the economy. Too much thinking. Equal weight. And that's great because we have a service where we believe we can be like a pillar of their wealth. And we actually don't want them to take a lot of risk. We want them to say, I could take a lot of risk, but I don't. But that doesn't mean that they shouldn't do it with other things in their life. And that's why I also believe that once we launch our second company, the crypto one, is that we will get a lot of crossover. But yeah, I would love to see, because then we have the data of two sides, whether people who invest like 100K in one, whether they only take 5K to the other. You know, that would be sensible, because it's a very asymmetric bet. But I'm sure we will see a lot of people who just move all the fun to the north. Yeah.
There's a Reddit forum called Wall Street Bets where people post their most wild bets. They go super big or they go super poorly. And to me, like, a part of me just dies on the inside when I see those numbers sometimes. Just so I feel like, why didn't you just balance your portfolio properly?
Yeah,
but
exactly.
it is entertaining to watch as an outsider.
Yeah, absolutely. It's I would say it's it's entertaining, but it's also and you know, you can do a lot of stupid things when you're young.
It's true. It's easy to recover from financial mistakes, from debt, from a lot of mistakes. Maybe having children is a little less harder to recover from, but barring marrying the wrong person, a lot of things are recoverable.
Yeah, a lot of and because that's also something that so like when I was always a very active saver. So when I was at university, I put away $20 a week or so, or whatever, and you know, that often cost me was the difference between going out or meeting people or investing or saving and or having a good meal and saving. And that pot of money now, and so I look at it every time, I paid from now 30 years, I paid $20 a month in it, and I put a lump sum in it. That money is now $40,000. And I think, well, in hindsight, that was not a smart choice, because $40,000 doesn't mean now a lot to me. But having robbed myself of a lot of good things in life, because I was so passionate of saving, I should have decided that, and I will teach my kids, hopefully that, should have decided that as long as you live hand to mouth, don't try to save, because then you make your life incredibly hard. Just work on your knowledge, work on university, study hard, get experience, invest, work on your friend's startup in your side, do some side gigs, learn how to run an Amazon store. I don't know. I mean, my daughter is 10 and she runs now a small Amazon store of shirts she has designed herself. And I think that's awesome, right? And I was
You introduced her to making NFTs.
should do. I should do. I should do that. So I told her, I said, like, do you know that people actually pay for pictures? And you digitize them, and then but you only can digitize them one, because, you have to change something, because then it's a new one. And she said, oh, that seems very easy. So yeah, it's very, very easy, but I don't know whether NFTs would be the best learning in my child's life.
I look at the CryptoPunks project and I'm like, dang, I don't understand. How are these people making so much money off these tiny little pixelized JPEGs of
Well, we had
AI generated art?
Yeah, we had the first one was CryptoKitties, right? And CryptoKitties congested the network for months, right? So I couldn't move anything. I couldn't. If I bought something at one of these Uniswaps, I had to pay like $100 for every 1,000. Like, it's like insane. It's like just because the CryptoKitties, they ate up all the gas. Hungry kitties, those ones. Yeah, but yeah.
Well, I usually.
What do you think about NFTs?
I have a few ideas. I feel like NFTs as a concept isn't as crazy as people think it is. I just want to see it in more practical use cases. I think NFTs are effectively just a digital, unique redemption / ownership / like demarcation of you having some sort of like access to it or a connection to an entity on a one-to-one basis. For example, that already exists anyways, right? Like you think about movie tickets, only one person can sit in a seat. Airplane tickets, only one person can sit in a seat. Concert tickets, only ever so many tickets. I don't know. Like I feel like there's so many use cases that have yet to be explored.
Yeah, you can have a house, right? A house could be in an NFT.
It could. Yeah. But until you come up with a legally binding clause that says that this NFT maps to this right or this property or this privilege, I feel like I just need more utility before I, like, as a consumer, want to jump in. Like, if an NFT, I've been thinking about an NFT startup where, like, an NFT maps to ad space. So that whoever owns the NFT owns the ad space. I feel like that's a pretty intelligent way of doing things. Versus just, I don't know, something more traditional. But I feel like the NFT creative space around it has so much untapped potential, and I think people need to push the boundary a little bit more each time. I recognize that these like CryptoKitties, CryptoPunks are a little silly, but I do recognize they're at least pushing the boundary.
Yeah. I was a bit disappointed that when Crypto.com bought the rights on the stadium, that they actually didn't do it on an NFT basis. So the stadium would basically put the rights on an NFT, and then Crypto.com would buy it, because then they would have, even
made
more
a huge
press.
splash.
Then it would be more press. I thought that's a missed chance.
I mean, it's not over. They once you have the naming rights, you can. It doesn't seem unreasonable for them to auction it off. And I have no doubt some billion out there who's going to auction it off for who's going to put their bid on it for something significantly above what they paid for it.
Yeah, because you could auction it off for a month, right?
Yeah.
And just
NFT rentals, I feel like, are going to be a thing.
Yeah, exactly. I mean, the ad space is a kind of a rental, right? Because the space is static. So yeah, when you own it, you own it. I mean, there will be a lot of applications, but I think what crypto often, and you have to like it or hate it, but crypto's initial application for some things is just it's just poking fun, poking fun with the system. Like, look what we can do. It's more like, look what we can do, rather than let's find a use case. Because I think it's more in this whole space is more innovation. And it's innovation for innovation's sake, which is really good, right? It's the same as,
I agree.
It's the same as space races. So a lot of people are complaining about that Branson goes to space
Waste money
and spend 130,000 car kilometers in whatever it was. I don't know exactly, but to go to space. And I think, it sounds as an event, it sounds very wasteful, right? But if you look at the whole thing, I mean, carbon fiber, which is one of the lightest and strongest fibers we have now, it's all made in space, and it's all made because of the space races, right? So, and that carbon fiber makes very light cars that use less electricity or less gas in combustion cars than traditional steel cars. So, yes, was it really wasted time to go to space? No, probably not. But it was innovation for innovation's sake, and sometimes you need it to go to the next step.
Yeah.
Right.
So right now I own a customer service agency with my business partner who's also a co-host of the show. Mm-hmm. And something we're really considering is taking our company and tokenizing the company, and effectively one token equals some fraction of equity in the company. So instead of like some ICO is going to be like it's an STO, like a security token offering at some point we'd like to do.
Yeah.
And then instead of having like a public stock in the like New York Stock Exchange, you can have a privately exchanged, or I guess a decentralized token that represents equity in your company that is going to be backed by like financial, reports of saying like we had this much revenue, this much earnings, this is our growth, these are projections. And I feel like part of it is doing innovation for innovation's sake, because you never know what problems are there until you get there.
Yeah, and in theory, especially when you start to pay out dividends in the coin itself, well, then you basically grow the coin itself. It's an internal process, and you probably don't have to pay taxes over your dividends. Then,
actually, in the U.S., you have to pay more taxes.
Oh, really? Oh, yeah. Well,
sorry, it's questionable. It's questionable whether security token payouts are considered income or dividends, because there's not a clear. I would like to interpret the law a certain way, but I'm pretty sure the state of California and the federal government wants to interpret it in the way where they get to take the most taxes.
Yeah, but it's a problem because that token doesn't have a residency. So if you issue a token and I buy it and I get a dividend from that, here in Australia we have different rules, right? So
that's what I would love for it to. I would love for it to work that way. But when I was looking into it in the U.S., if you want to tokenize your business and your token looks like a security, as a resident entrepreneur of the United States, it falls under SEC jurisdiction. So depends if you're really anonymous and get away with it. I probably don't want to go down that route just because I would like to not end up behind bars, even if I think it's kind of silly. But I think the law needs so much work to adapt to the modern times.
I mean, yes, and that's the interesting bit about law, right? So, and I'm spending so much money on legal that I think, I sponsor this whole industry. But in the end, it's the backwarded laws that are still based on land ownership and sometimes even the slavery acts and stuff. And you still find them all over the world, like these small laws in the corners that are not used, but when you look at it, think, that's not from this century, that's a long time ago.
In America, there's still some really ancient laws that reference race-based power imbalances, and to me that's ridiculous. Like, it's 2022. How have we not, almost 2022, how have we not automated all, like, the scraping of all laws and just erase everything that has anything to do with race, or even gender? This is crazy to me.
Yeah, let's just remove it. It's because when you change the law, you change the jurisdiction over it. So, it's really hard for people to change things en masse. Anyway, so that the law when it comes to investing, and also, there's so many unfair things. Like here in Australia, but also in the US and the UK, you have laws around sophisticated investors. So, in Australia, sophisticated investors in funds are supposed and are able to renegotiate their fees of the fund. Retail investors cannot. That's strange. Then if you look at, so you have, we have, for example, $100,000 saved up, and now I want to go to Bridgewater. And they say, nah, you have to bring at least 10 million. So when I'm rich, I have more opportunities because of a law made up by probably rich people at the time, that some opportunities are only for rich people. And I think, that's so wrong. That's so fundamentally wrong. But I still have to live with it. So we had to start a wholesale investor fund first, and then convert it to a retail fund. And then suddenly all the rules changed. I was like, why is that? And he said, yeah, that's because now we're for everybody. So yeah, then you cannot negotiate fees, you cannot make a deal, you cannot do anything different. Okay, that's a lot.
In America, the equivalent is the fact that to be an accredited investor, you had to have made $200K in the past 2 years as a single person, or $300K as a married couple, or have over $1 million in liquid net worth, excluding your primary residence. And it's interesting because it's based in the last 2 years, but due to COVID, people like myself have left our jobs and we decided to pursue entrepreneurship. So I haven't been paid. So I'm definitely not at that. I've lost my accredited investor status, which is so interesting because these funds I used to invest in are now asking me for paperwork. So I don't know if I can provide that paperwork anymore, and it gets a little wonky because of that.
Yeah, and that's. I mean, I had a lot of discussions with people what you can and cannot do as an investor into a fund, and so basically, this you have in the US the crowdfunding law, right? And here you have the similar things. In the US, it's expanded to 5 mil.
It's a relatively small amount.
Yeah, relatively small amount, and then here it's 3 mil. Then above 3 mil, you become basically a public company. But if you want to invest more than $10,000 into a startup, you have to go to all the hoops. You have to be a accredited investor. You have to have your AML checked out. You have to have a declaration from an accountant. Most people don't have an accountant. While I can take my credit card, go to Vegas, and slap $100,000 with my card on red, right? So, and I said that to the lawyer. So what you're actually saying me, if I have $30,000, you're going to prevent me to invest $30,000 in a startup that could be an asymmetric bet and could pay out later, but at least it will create innovation in society. But I'm not allowed. But I cannot take that same $30,000 and put it on red in the casino. Yes, you can. Okay. Okay. Well, I threw the $30,000 and bought Ethereum. They can't stop that either. Right. But it was really remarkable, and there's a lot of laws and a lot of regulation that are basically protecting people. But if you look at the effect, you take away opportunities, and taking away opportunities is usually not a positive thing.
Right.
In the especially when you hide it under we're protecting you. Mm-hmm. Well, maybe I don't need protection. Right?
I think so. Recently, I currently reside in the state of Texas, and Texas changed the law as of September 1st. So without any licenses, if you're a non-felon, you can go into any typical store, just buy a gun and walk out. And I'm like, dang, that's so interesting.
Yeah.
That is so different from the world of California.
Oh yeah, California has very strict rules around that. Right? Well, and I think it's I'm happy your podcast is about entrepreneurship and innovation, and not about guns, because first, the innovation in guns is might be unneeded. And secondly, guns in society, I don't know. I'm not a real fan.
So I've been to 2 shooting ranges in my entire life, both of which were outdoors. So sorry, 2 or I think I've been to 3. And out of those 3 times, 2 of the times there was a kid who was holding one of his, I don't know, his father's or uncle's guns and was not handling it properly. And I was like, that's an actual physical risk if you like pull the trigger while aiming at the wrong thing.
Yeah.
And I'm like, I don't know. It's a strange world when guns have too easy access.
Yeah,
I don't consider myself all that political, but I would like to not die via accident with guns.
No, and in some countries it's much worse than in the US or in Australia. In Australia, they banned basically all guns except when you live on a farm and you have to shoot
like wolves,
kangaroos,
coyotes. Okay.
Kangaroos. I don't know what they shoot. They probably shoot foxes because we have in Australia there's less native animals, and native animals they somehow they made a whole animal kingdom here without any real predators. So it's very interesting. But then when the people came, they introduced a lot of them. So dogs and foxes, and they, foxes were introduced for fun, and now they're a big problem because foxes have no enemy except cars. But yeah, it's
this has been a really fun hour.
Yeah.
That said, I just want to be respectful of your time. I'd love to give you the stage now for the people in the audience who are following along this episode and want to follow you or your company's story and, I guess, evolution. What's the best way for them to do so?
Well, at the moment we're on unhedged.io or unhedged.com.au. That's one way. The other way, I mean, yeah, just become part of our newsletter, and then we'll keep you posted. I mean, we talk a lot about investing in a broader scheme rather than narrow scheme. But I think what's really interesting, especially for people in the US, is when we start to do the crypto part. Because, we are our ambition, we build this company from scratch to go international. But at one point we thought, international is basically you can do it in 2 ways. You can go in crypto, which basically doesn't have a jurisdiction, or you can take the trouble to go from country to country, which I believe both we should do, as long as we can get enough funding in a Series A to do so. But so especially when we dive into the automated yield farming and the algorithmic-based position taking in crypto, that's a very interesting time for US readers also to see what we're doing.
Okay. Well, definitely send me an email once you have those crypto products ready. I would just love to take a look. I love almost all products in the world of crypto. Maybe other than the dog-based projects. Anything that has utility, I'm totally down to learn more about.
Yeah. I don't know why we don't have any cat-based products or. Yeah.
So I actually looked into it. There are some cat-based coins, but I think in general, for whatever reason, the social virality is significantly lower, and that's why they don't really take off.
Yeah, that's an interesting one. I think at one point there will be a psychological study about this by someone who couldn't find a topic for their PhD.
People 200 years from now will look back on this time of history and just ask so many questions, and maybe many of which they won't have an answer to.
Yeah, a lot of whys, I think. Yeah. Yeah.
Well, thank you very much for joining us on the show, Peter. This has been really great, and I'm really thankful for your insights.
Okay. I'm very happy to have shared our story and come on your show, David.